Happy New Year, everyone. This is Jim Bell, founder and president of Bell Investment Advisors. I'm here to welcome you to our webinar today. Why is the market so strong and what could go wrong? This is our look back at 2017 and looking forward at 2018 and this current bull market. I'm happily joined today by Corinne Salera Bedford, certified financial planner, portfolio manager here on our team, and an investment advisor. So thank you for joining me today, Corinne.
Oh, it's great to be here. Thank you, Jim.
If you're having any technical problems, you can please call our office at 800-700-0089. That's at the bottom of your screen there. So we would welcome the opportunity to help you should you need it. It's not working. We're just having a little, there we go, a little delay on forwarding the slides. This is the overview of what we're going to cover today. As I said, we're looking back at 2017, and we'll address this current bull market now that we're into 2018 with a very strong start. We're going to address international equities and the opportunities there. Talk about fiscal policy and the new tax bill, which is a big deal, and monetary policy with changes at the Federal Reserve, and of course the now increase in interest rates as policy from the Federal Reserve. What impact is that going to have on 2018? So Corinne's going to take us through this slide on geopolitical concerns.
Yeah, thank you, Jim. So what you're seeing here are the top 10 risks to the world per a Time magazine article that was published on January 3rd, 2017. As you scan this list, I'm sure you're reminded of the challenges that we encountered in 2017. I'll highlight just a few while you read through the top 10. The first I want to highlight is number 1 in unpredictable America. What the article refers to is Trump's America First stance in an overall less predictable foreign policy than past administrations. No matter where you stand, if you're for or against Trump's policies, I think we can all agree that certainly he is a bit less predictable. The next item I want to highlight is the third there, the power vacuum in Europe. What this was referring to was simply a lack of leadership, and certainly the unknowns surrounding the elections in France, Greece's finances, the Brexit negotiations, and a numerous of other items that Europe was facing last year. Luckily, much of this is going better than expected or concluded with less controversy than predicted on January 3rd, 2017. The last item I want to highlight is number 9, and I'm sure it's pretty self-explanatory, but unfortunately does remain a global threat. North Korea and its leader and their missile pursuits remains a global threat and something for all of us to be paying attention to. But we wanted to start on this slide because even amidst the numerous geopolitical concerns out there and that I've highlighted here within the list, and those I'm sure you're thinking of that are not listed here, economic growth persisted and the fundamentals remained quite strong, which is why we believe the market had such a strong year in 2017 and could potentially have another strong year in 2018.
I meant to say in the introduction that we welcome your questions. You can submit those in the chat box, and we'll answer them as we can. If we aren't able to answer them, we will make sure to get an answer to you. So please use that chat box. Corinne?
Thank you. So what you're looking at here is a chart of the Morgan Stanley Capital International All Country World Index over the last 12 months, so essentially 2017. And what you see are different headlines published across the world that are mostly positive representation of those strong fundamentals that we mentioned earlier on that really underscored the year and sets us up for another strong year in 2018. So I'll read just a few to you. The fourth one in says U.S. consumer confidence reaches highest level since 2000. Just below that, Eurozone confidence hits post-crisis high. One to the right, unemployment rate falls to 16-year low. That's in the United States. Some of the other headlines comment on the strong performance across global stocks, the strong U.S. profit growth seen, surging new home sales growth, etc. I'll leave you just with these last two here. The UK and the EU reached deal on Brexit divorce terms. And then finally, Trump signed sweeping tax overhaul into law. That happened on December 22nd, and something I'll detail a bit more later on in the webinar. But to dive in immediately to the title of our webinar here, why is the market so strong? It's really these fundamentals that move the markets forward, and again, something we believe can persist in the new year. Another theme for the year of 2017 was the unprecedented low volatility environment. The VIX that you see here is a key barometer for investor sentiment and market volatility. And in 2017, the VIX index had its lowest low, its lowest high, and its lowest average. So truly unprecedented. Another measure or another way to demonstrate the lack of volatility we saw in 2017 is the fact that the MSCI All Country World Index that we showed you a chart of earlier declined by more than 1% on just 2 days in 2017. That was the fewest number on record. So in general, market drawdowns of 5% occur on average 3 times per year. Market drawdowns of 10% occur on average about 1 time per year. Neither of those things happened in 2017. So truly unprecedented low volatility environment that we saw in 2017. And although 2018 has began with quite a lot of strength, we do expect a more normal environment, which will also mean a more volatile environment. I'll now turn it over to Jim to discuss the current bull market a bit more.
Thanks, Corinne. So I'm sure you've heard that this bull market that we're in, that started back in 2009 with the recovery from the Great Recession, is getting long in the tooth. It is the second longest and largest bull market in recent financial history. You can see along the bottom axis that we're measuring this bull market in months. And we're over 100 months since this began in 2009. The record was set in the 90s, where from 1990 to 2000, that bull market lasted 120 months. So there's a strong likelihood that we're going to set a new record. And one of the reasons being, as Corinne was referring to, the international markets, or the markets in general, with everything that happened in 2017. I was just reading yesterday in the Wall Street Journal that the 2 largest aircraft manufacturers in the world, Boeing and Airbus, had their record year. Never in the history of the world has there been so many aircrafts produced in a calendar year. And in spite of that, their order backlog is still growing. So as much as they've been able to produce at record levels, the backlog for orders is still growing. That's a sign of very strong global demand and dynamics that occur when all of the world economies are growing at the same time. And Corinne will address the synchronized global growth in a couple of slides. In terms of this bull market and this economic expansion, we wanted to look into some history here about how long expansions have lasted or been able to last in recent history. So you can see here the note on the left-hand side there that the average expansion length between 1904 and 1980 was about 3 years. And that was an average calculated over 76 years. In this more current period, since 1982, you can see the average economic expansions from 1982 to 2017 has increased. It's more than doubled to 8 years. So this indicates that we probably are very well in a different environment. I don't know exactly what to attribute this to. I think it might be the long-term effects of increased technology and productivity, and it could also be just more sophistication among central banks who have increased their toolbox. So getting back to the age of this market, just because this bull market is in its 9th year going on 10 years, it doesn't mean that it's likely to end. These aren't biological entities. And the point here is that recoveries, they don't die from old age, but something intervenes. And a few examples here is first one being that the central bank policy here in the United States and around the world could make some missteps. Milton Friedman, the classic Nobel Prize winning economist, wrote an article in today's Wall Street Journal about the great unwinding, that we all know that the US Fed and even the other central banks around the world are backing off on their quantitative easing. Interest rates are going up, and they're going to begin to unwind the balance sheet, their balance sheets, from the purchases of debt securities that they made over this period. So that's an unknown. That this is uncharted territory, as Dr. Friedman refers to it. We've never been through an unwinding as is beginning now. So it's a bit of a wild card. Second example here is a recession. Certainly, should the United States fall into recession, that's going to have an effect on the bull market, transitioning perhaps to a bear market. There's very low probability of a recession, certainly right now in the United States and possibly even in the world, with strong gross domestic product growth and increasing corporate earnings at a pretty steady rate, and the low unemployment numbers. A shock from overseas could come in many forms. One could be war, certainly. The other I'd like to point out is our trade deals with groups of countries and individual countries. As you know, this current administration is a bit hostile to these group trade deals that have been made, walked away from the Trans-Pacific Partnership, and is threatening to get out of NAFTA. And that would not be good for the stock market or for American consumers. One of the reasons that consumers pay low prices for goods is that they're manufactured very efficiently overseas. So that's another thing that we're keeping an eye on. So finally, just to give some examples of other countries, as I've referred to, the current U.S. market for an expansion is this 10 years that occurred in the 1990s. In Britain, an expansion lasted 17 years that also started in the 1990s. And in the Netherlands, one that started in 2008, I'm sorry, 26 years before 2008, indeed did last for 26 years. So there's no rule book that says how long an expansion can last. I'll turn this back to Corinne to highlight more of the synchronized growth around the world.
Yes, as Jim mentioned, we have seen a strong economic expansion, and this chart here really highlights that. Essentially, it's a heat map of the Purchasing Managers Index. So green shows the acceleration of that index within a region and for that particular month. Red, deceleration, yellow and orange, essentially neutral readings. So what the PMI is, it's an indicator of sorts of economic health and current business conditions. So there are 5 major items within the PMI: new orders, inventory levels, production, supplier deliveries, and the overall employment environment. So I want to draw your attention to just one reading here, and that's the December 2017 global reading of 54.5. That was the highest reading since 2011, and again, just reiterates the strong economic and expansion that we're seeing across the globe. Sticking with equities and comment on international stocks in particular, I'll orient you to this chart as well. The top line, which is gray, hopefully you can see that, shows the performance of the S&P 500 index since 1997, while the bottom line, which is purple, shows the performance of the MSCI All Country World, excluding the United States during that same time period. What I'm sure is clear visually is that there's a divergence in terms of where the international indexes, as represented by the MSCI All Country World ex-US, versus the US index or the S&P 500. The international market is not yet back to its peak set in 2007, whereas obviously the S&P 500 has exceeded that point many times over. So our point here is we do believe that international markets have more room to run. One other point on that matter is the valuations are more attractive overseas. And why and how I draw that conclusion is in looking at the price to earnings ratio that can be found in the box in the upper left-hand corner. So the PE ratio for international markets is 14.3 times earnings, whereas within the US, it is 18.2 times earnings. So that's one other reason we think international markets look and are more attractive. The final point here is the dividend yield is also higher and more attractive overseas, with a dividend yield of 3.1% across the seas versus within the US, the dividend yield is 2%. So again, there are many indicators, 3 of which I've indicated and discussed here, all of which should bode well for international markets. Switching gears a bit, we promised to discuss the tax reform that was signed on December 22nd. Well, many of you hopefully were vacationing and on holiday. The Tax Cuts and Jobs Act was signed into law. So just a few details for individuals. The reduction of the top tax bracket was brought down from 39.6% to 37%. And also the standard deduction was increased. These 2 items together should mean lower tax payments and liabilities for most Americans. That said, Californians are unlikely to be as lucky, and that is because there is a limitation on certain itemized deductions, one of which is a limit on state and local taxes up to $10,000. So Californians and other residents of high tax states will likely be, this will be detrimental, that one piece of the legislature. And finally, I did want to mention that there's a higher limit for estate tax, which will mean even less people will be paying estate tax than prior years. So I'll pass it on to you, Jim, to talk about the tax reform bill in light of corporations.
Thank you. So we did want to show you a graphic about the impacts or the degree of this tax cut for U.S. corporations. As you can see, the blue line on the left was the tax rate as it stood before the tax bill was signed in December. At the 35% rate, you can see among all these economies, it was the very highest. In the middle of the page is the current status of our corporate tax policy or tax rate, and you can see it's very, very close to the kind of the global average. So that's a big step and very favorable to corporations and business. Whatever you think of this tax bill or the current administration, this move is definitely good for business. It's good for stocks, and we may as well reward ourselves for that or participate in the value that's being created from that.
Jim mentioned the unwinding of different central banks' balance sheets, and this graphic on the left, it's a visual representation of what he's already mentioned. This is really central banks' way of responding to the stronger economic data that we're seeing. So essentially what we're seeing is that there's going to be no more quantitative easing from the Bank of England, tapering of QE from the Bank of Japan and the European Central Bank. And then, of course, as most of you I'm sure are aware, the Fed will actually be reducing their balance sheet over time. What you'll see on the right side of this slide is a depiction of the rate changes over the different years since 2008. Overall, there has been a move from more rate cuts, which is the gray bars there, to more hikes that we've seen in recent years. That's the blue bar there. So honing in on the Fed and within the U.S., the new Fed Chair Powell and the Fed itself, they have maintained a commitment to be data-driven and take gradual action. So that certainly is a positive in our minds. In 2017, we saw 3 rate hikes, and that is the same number that's forecasted for 2018. So just to share with you all, in 2017, U.S. bonds were positive for the year. In looking and honing in on the U.S. Bloomberg Barclays aggregate bond index, that was up 3.5% for the year of 2017. So it certainly is possible for bonds to have a positive year, even in light of interest rate hikes. This chart here, the orange line is what the Fed controls, the federal funds rate, where the blue line is the 10-year Treasury note yield, which, as you can see, it does not move in lockstep, but certainly follows a similar trajectory to what the Fed controls, which is the federal funds rate. So again, as we mentioned, it is certainly possible for interest rates to be positive again in 2018, but I will say it is also possible that they will end down, have a down year like we saw in 2013. Those of you who are invested in bonds likely remember this, but the Bloomberg Barclays Ag ended the year down 2% in 2013. So a down year, but I will share that down 2%, that can happen in the stock market in 1 or 2 days, where it took a whole year for the bond market to be down 2%. So we are hedging this interest rate risk that we see by focusing on shorter term bond issues. And we also have some global exposure, which we think is beneficial given international bonds are in a very different place. Interest rates are in a very different place internationally than where they are in the United States. Finally, we wanted to be sure to comment on how interest rates could impact the stock market. We've had a handful of clients ask us about this, and we thought this chart really answered the question well. So the x-axis here, again, is that 10-year Treasury yields that I just was touching on. And really the most important detail here is that orange line, which really delineates an important transition. And I'll read you here what it states right next to that orange line. It says, when yields are below 5%, rising rates have historically been associated with rising stock prices. So essentially, after that point, when the 10-year yield pushes up over 5% into 6%, that's when rates and the 10-year Treasury yield can have a dampening effect on stock market returns. And obviously, we're not there yet. The 10-year Treasury yield is sitting just at about 2.5%, with potential to get to 3 by the end of the year, but it's essentially nowhere near 5 or 6% when it could impact the stock market negatively.
Thank you, Corinne. So, in summary of the information that we've shared with you today, we just want to reiterate that we believe risks to the equity markets remain quite low. We've communicated some caveats that could upset that, but the momentum and the global strength and demand is very, very powerful, and we expect that to continue. International equities, as Corinne showed, are good value. They have much more room to go to catch up to the United States. So we're happy and proud that we are utilizing international diversification in that way. As I mentioned, the tax bill is good for business, and we believe it's smart to go ahead and participate in the rewards that are coming from that. And finally, as Corinne talked about, bonds remain an important asset class, and in spite of an increasing environment, interest rate environment, it's important that we don't forget why you own bonds or why we own bonds. They're a great source of stabilization and diversification, and an important source of stability in your investments.
So we do have one question that came through. I think we're prepared to answer, and that is, will 2018 be similar to 2017 for the equity markets? That's really a great question. And as many of you know, 2017 turned out to be a very strong year for the equity markets. And as hopefully we've demonstrated here today so far, we do expect positive returns in the equity markets for 2018, but certainly not to the extent and degree that we saw in 2018. Given, again, what we shared, we expect volatility to pick up and returns to be more in line with historical norms than the essentially blowout year that we saw in 2017.
Thank you, Corinne. Of course, no one can completely predict what's going to happen tomorrow or for the rest of this year, but I appreciate Corinne's answer there. We just received another question that, if you don't mind staying with us, we will attempt to answer. We're just going to take a minute to look at this. Corinne, you can join in here with me, but this is a question that I'll read it. Although we're not there yet, how would you best position yourself when the market does turn? Thank you for that question. One of the things we've certainly talked about for the 27, 28 years that we've been in business is that we don't believe in market timing. We certainly searched long and hard for a system that would help us do that, but we've come to the conclusion that it's really a fantasy, and we've stayed away from it just from the research that we've seen and the effect that it has. As Corinne was mentioning, we are certainly adjusting our bond allocation towards shorter durations to reduce interest rate risk. And I would just make the comment that what we've seen over these years is that it's really the most important thing is for each client, each investor, to have an investment strategy and policy, ideally that comes from their own personal financial plan, that indicates, what is the best long-term strategy and allocation for you, and within risk parameters, to take the least amount of risk to make your life work well financially. So that's more important than questions about, what should we do when the market goes down? Of course, it's going to go down. That's what markets do.
I would echo those thoughts. Essentially, to Jim's point, as long as your investment strategy and allocation is in line with your risk tolerance, it doesn't matter if there's a drawdown, as long as you're able to stay invested and write it out and see the returns on the other side. So that's the most important thing here, is if someone doesn't feel they're able to stomach a drawdown of the equity markets, which could be in the range of 50 to 60%, that's what happened from the 07 to 09 downturn, then that should be a conversation with your advisor to get you into a strategy that you're going to be able to stay consistent with.
Finally, these questions are coming in fast right now. We have a final question about stop loss orders. So what can we say in regard to that, Corinne? The question is, do we have stop loss orders on the mutual funds and ETFs? Do we have a strategy there?
We're certainly able to execute stop loss orders if the environment calls for it. In general, when we're purchasing a large ETF order or sell order for that matter, we do work with the Schwab equity desk and ensure that we get the best possible price. But if a client has a specific security in mind, we are able to introduce and execute stop loss orders. I would simply say it'd be more on a case-by-case basis.
Thank you. So that concludes our time with you today. Thank you for joining us. Please contact us if you have more questions. We will make sure to get them answered. This webinar has been recorded, and it will be posted on our website in about a week. You can see an inventory here of other webinars that we have in our website library. So we encourage you to take a look at those if you will. And if you would like a copy of the slides that Corinne and I posted today, we'll be happy to send you a copy of all the slides. Just send in a request and we'll get those out to you. We always appreciate you staying in touch with us. Thank you for the 3 questions that were submitted in this webinar. There's lots of ways to reach us and stay in touch with our career and life coaching blog and our finance blog. We're always happy to hear from you. So again, Happy New Year, and we appreciate your interest, and we look forward to presenting to you again. Bye now.
Thank you.